Welcome, everyone. Please don't forget to check in for everybody that is online. I will drop the check-in link in a moment once Chandra gets started. So, our program schedule, we have a few more classes left before demo day. So, today is financials and sales with Chandra, who's amazing. Supply chain is August 25th. Pitch practice is the 27th, and then pitch or demo day, whatever you want to call it, is on August 29th, and that is our last day together. So I guess let's get started. Chandra, do you have your own deck that you will be sharing, or are we?
No, well, I'm using the deck that you have here. I don't have one with my face in it, the one that you have, but I'm sure it's the
Oh,
same information.
okay, that works.
And
Hold
it
on.
also says that I can't share, oh, because you're sharing a screen. But I can, it's the same deck, so I'm happy to share my screen.
Okay, perfect. Let me stop sharing so you can. Okay.
All right, let's see. Okay. Is that right?
Yes, I believe it is, but I just need to find you now. Give me 1 second. There you are.
Okay. Now I've lost my screen. Here it is. Okay. Wait, where'd it go? Okay, gotcha. Let me just make sure I can toggle through.
No, hold on.
Okay.
I lost you. That's on my end, Chandra. I'll figure it.
Oh, I was like, is that me?
No, hold on. Poltergeist. Okay. Okay. Is that the deck?
Yes,
Perfect.
but I'm going the wrong way. Here we go. Okay, guys. Okay, so I like for this to be interactive if possible. I know some of you guys are in a classroom and there are others that are on. So if you have a question at any time, feel free to hop off of mute and ask me anything. There'll also be time after my presentation for you to ask me specific questions. But the way that I like to run these sessions is really make them as applicable as possible. So, depending on the type of business that you have, there may be some examples in here that don't particularly make sense to your specific business. So, if there's a question that you have about how you can apply it to your company or your industry, please let me know and I'm happy to do that. But today we'll really dive deep into the making sure that you understand the numbers of your business, which is something that I have been talking about for, I don't even know, years now, 2018, which is when I started working in investment banking. So, a little bit about me, I'm a former tech investment banker. And what I realized during that time as an investment banker is that a lot of companies don't know how to tell the story of their business in numbers. And so, I took that information that I was learning, that corporate finance, and applied it to my community of founders, my community of company owners that were just winging it, didn't know the questions to ask, didn't know what they didn't know. And I wanted to take that information that I had learned working on Wall Street and making sure that I could help them get funding. So from there, I turned that little side practice to, I turned it into a fractional CFO and accounting firm. So I've been running that for 5 years. And I help founders raise we're probably at 50 million now. Some of my companies and clients are valued at over $150 billion. Some of them I started with when they were literally at inception. So I very much understand and am very close to the startup and small business growth trajectory. And so what we'll talk about here today will make sure that you are on the right path, you're asking yourself the right questions, and if you are looking to get investment or any other type of capital, that you are prepared and ready to answer the questions and get the money as soon as possible. A lot of times, what happens is founders aren't prepared. And so it takes longer. And so when you were at 6 months and trying to of runway and trying to go out and raise, and all of a sudden now you're at 1 month trying to go out and raise. So we'll cover all of that today. And then I'll obviously, if you have any questions, I'll put my email in the chat. You can also reach out to me on LinkedIn and I can help you that way as well. Okay. So the first thing we'll talk about is really making sure that you are one, measuring the right things and you are making predictions based on those measurements. Am I missing things in the chat? I'm sorry if I am. Oh, okay, that's a check-in link. Great. If I do, like I said, I won't be looking at the chat. So if you have any questions, just feel free to come off of mute because the chat is on my other screen and I don't want to miss anything. Okay, so the cycle of measuring anything in your business is one, you're going to make assumptions, right? When I'm modeling out or projecting out revenue for my clients, there's a lot of things that I have to make assumptions on because I don't have the information, right? So I'm predicting a lot of what I think is going to happen. Then we'll go into a quarter, 2 quarters, or a year of actually selling product. And then I'm measuring revenue, I'm measuring margins, I'm measuring sales cycles. From there, I'm taking information and saying it takes us a really long time to turn a customer or a prospect into a customer. We need to make sure that we have enough cash flow to ride out that process. I think that from now on, let's say the next 2 quarters, we're going to need $100,000 to run the company, and we'll be able to close 3 clients within that time frame, and that operational capital will be able to float us. That's me predicting again after analyzing the data, measuring the data, and looking at my initial assumptions. What I'll say here is that when you are thinking about projecting anything or measuring anything, there's 2 things I'll say. When you're thinking about projecting anything or measuring anything, you want to make sure that you are using industry standard metrics. A lot of times people say, well, I don't know what to measure. One of the things that you can do is you can go to, I don't know the web, sec.gov, something, I don't know, guys. But what I'll say is that once you get the filings of any public companies that are in your industry or adjacent to your industry, annual reports, 8Ks, S1s, reports that those companies have a fiduciary responsibility to produce for their investors, that will give you a lot of information on what to measure. Obviously, it's not at the same scale, right? You're a small company and these companies are really large, but it allows you to see how those companies are, one, evaluating risk, two, measuring their own success, and how investors are measuring their success as well. The other thing I'll say is that you cannot improve upon anything that is not being measured or accurately measured or captured and quantified. So if there are parts of your business that you want to measure or improve, especially tying that to revenue goals, you have to measure it. I don't believe in just measuring revenue as a sign of success. One of the things that I do in my business and my fractional CFO company is I measure the time that it takes for us to reply to an email. I want to make sure that we're replying within a certain time frame, and anything outside of that is a failure to me. And so I want to make sure that, and that to me equates to revenue, not immediately, right? But it's going to make customers more happy, so higher customer success rate and then higher referral rate. Okay, so I'm saying all of this outside of just financial management because it's bigger than financial management, right? The way that you're looking at your business and the way that you're quantifying your business should not just be through your income statement, balance sheet, and cash flow. However, those 3 statements, that financial package, are the things that investors or lenders are going to be looking at. And so those are definitely things that you need to be focused on. Also, if you're doing any projecting or thinking about what could possibly be your revenue or your net income or how much money you're going to have at the end of the year, you'll have to understand these, well, not all 3, but you'll have to have a sense of how these 3 financial statements work. So the primary financial statements that you guys should be focused on and paying attention to. And I know I say that and I'm smiling, but There are a lot of founders that do not actually pay attention to their financial statements. So I want to make sure we spend time really going through that because that is the basics for you as a founder. So the three statements are the income statement, which is also the P&L, profit and loss, the balance sheet, which houses your assets and your liabilities, so what you own and what you owe, and the cash flow statement, which talks about the cash that's come in and the cash that's come out. The way that I like to explain this, I'm going to try to explain this in a way that makes sense to people that are not necessarily in finance, though some of you may be in finance. Your income statement and your balance sheet are the ways in which you can tell how money or the promise of money has what has transpired in your business, right? So whether you're doing something on accrual or cash basis, it will always be recorded on the income statement and balance sheet. I'll stop there and then we'll go into details. I was about to go very deep and not necessary. Okay, so let's do a review of all three of those. And again, there'll be some examples in here, but again, if there are some places or areas where you want to see how it fits your business specifically, I'm happy to do that exercise with you to see if we can come up with an income statement or a balance sheet that is more germane or specific to your industry. Because again, they change based on the type of company that you have. So this income statement, it shows whether a company is profitable. And so what that means is how much money do you have left over a period of time? So that could be month, quarter, year. Those are usually the ways that the time frames that we're using to measure profitability. Typically, profitability is more of like a general way to look at the business. Is the business profitable? Yes, it could be profitable on a month to month basis. So like month one, you could have $1,500 left over. Month zero, you could be in the red, 2,000, and month three, you could be in the black, profitable again for $50,000. But generally, what we really want to see is over time, are you able to run your business efficiently so that you have money left over? So is your business profitable? And right now, if you're looking for equity investment, so investors come in, give you cash, and they get a piece of your company, or they get ownership in your company, couple of shares, couple of percentage points. What they're really looking for are businesses that are profitable. There was a time in the recent past where investors really just wanted your business to be as big as possible, but now they want a more healthy, sustainable business in which you could essentially run the business on its own revenues. And all they're doing as investors is really blowing it up to introduce scale into the company. Again, there are a couple of names for the P&L or the income statement. There's a profit and loss, P&L, the statement of earnings. I usually typically call it the P&L, but income statement or any of those names work. The general thing to take away from the income statement is this. I don't know if you can see my cursor, but this line right here, this operating income, we can get really technical in these different terms, net income, operating income, EBITDA, like all these things. But the general thing to take away is how much money do you have after you bring in revenue from your customers, subtract your expenses, right? And that would equal net income. Any questions there before I move on to the next slide? No? Okay. Okay, so here's a very simplified version with an example of a company that sells running shoes. I believe this company is selling running shoes. Okay, so we have net sales. So these are the sales that you made for the year. And then we have the cost of goods sold. So this is the cost to you of the products that you sold. So this is a physical product. This is a CPG company. This is a consumer packaged good company. And for that, what that means is that the cost of the product would be in the cost of sales. Also, there could be shipping, packaging, things like that. So what did it cost you to produce that product? For you to produce that product, and the difference is your gross income. So if ever you hear people talk about margins or gross margin, that's what they're saying. They're saying it costs $10 to, I'm selling this t-shirt for $10. It cost me $5. Oh, that's my own hand. Oh my gosh. It cost me $5 to make it. And so that means I have $5 left over to run the business, right? It's 50% margins and I now have $5 to run the business. So I like to say this shows here that it's broken out into 4 different sections, but I like to say that your P&L is typically broken out into 3 different sections. Your revenue, your cost of goods, and then your operating expenses. The things that are fixed, like salaries, rent, insurance, after you sold your items and you've taken out the cost of goods, that money that's left over is what you have to actually operate the business. That's what you have to pay your people. That's what you have to market to customers. That's the money that you have left over to pay rent. So as we're marching down this income statement, we started with sales. So the amount of money that you've made on the product that you sold. Now we're at the cost of goods. This is how much it costs you to produce that product. You got your gross income, which is basically what's left over after you produce your product. And we can talk so much about pricing because there's so much leverage that you have to get as much gross income as possible. You want to get as much as gross income as possible because that allows you to operate the business. Now you have your operating expense, and then we get down to the interest expense, other income. So that's just like random activities that have brought you income. You have your income before taxes, any income taxes, and then you get down to your net income. Typically, honestly, for most of you, you're going to skip the interest expense. You most likely won't have other income, and you will probably have income taxes, but it depends on of your setup. But once you get down to your operating income, that will lead you to your net income. Any questions there? I'm doing so much talking, so if you have questions, please let me know. How do I get rid of this hand? It says that my hand is up. Lower hand. Okay, great. Okay, so I just want to make sure. Any questions before I move on to the balance sheet? No. Okay. Okay. Oops. Oh gosh. Sorry, it's going the wrong way. Okay, so your balance sheet is something that happens at a point in time. It's not over time, but it is at a point in time. So we typically look at balance sheets again, monthly, quarterly, annually, and it's a snapshot. So this is going to show your company and its financial position at a particular point in time, right? And what it's going to show is what you own and what's owed to you, and then also what you owe. The equation here to take away is assets equals liabilities plus equity. I hate that equation because it always confuses me. All I'm looking at, to be honest, is what money I have and what's owed to me, and then what I owe. Assets are what money you have, what cash you have in the bank, and what's owed to you, your accounts receivable, and then your liabilities are what you owe. There's also this section of equity, which is your retained earnings, paid in capital, but that's getting very detailed and probably maybe necessary to have a small discussion here. But what you really need to pay attention to and understand are your assets and your liabilities. So I will walk through this particular example, and then we'll do a similar example with the run company, even though I didn't really walk through that, but we'll use that. I'll use that so that you guys can get a full understanding of what the balance sheet is. So if you're thinking about a personal balance sheet and you decide to buy a car, let's say the car is worth $30,000. So the couple things that you can do, let's say you have $5,000 in cash, your $5,000 would be sitting in this cash and cash equivalents, right? You're going to purchase the car for $30,000. So you'll have $30,000 worth of assets, right? And then you'll have the $25,000 loan. And then once you actually purchase the car, your $5,000 in cash is no longer there. So that kind of walks through where you'll have where your asset sits and how that affects your cash position and your liabilities position. Okay, so here's an example of the balance sheet with that run company, the CPG, I guess it's running shoes, the CPG company. So it says here that and I didn't go over this, but let's just talk about it now. There's a couple of things that you're going to see on your balance sheet. Your current assets, your non-current assets, your current liabilities, non-current liabilities. And this is super simplified, but your current assets are things that can turned into cash within a year. So think about inventory, you can sell that really quickly. The cash that you already have in the bank, that's already cash, so that's a current liability. Any lines of credit are liability. Oh my God, current assets, sorry. Anything that could be turned into cash is a current, or within a year is a current asset. And then your non-current assets are buildings or cars. Large capital expenditures are non-current assets. Your liabilities are things that are due within the year, and then your non-current liabilities are things that are not due within the year. So if you think about AP, so you have to pay a contractor, a designer, that's going to be due within a year. That's any current liabilities. And the reason why we go into detail here is because once we get to the cash flow, we'll talk about why that's important. So just to make sure that I go through this example, like I said, current assets can be converted into cash within 1 year. We talked about some of the examples here. Current liabilities are financial obligations that are due within 1 year. Again, we talked about some of the examples here. And then equity, which I didn't talk about, is the value of the company after the liabilities have been deducted. So any capital that you contributed would go in the equity line item. Retained earnings, which are your aggregate of your net incomes, so the money that you have left over, that's going to go in your equity line. Owner's draw, so if you're taking money out of the cash balance for personal reasons or just because you're an owner, that's outside of a salary, that would be in your equity line item. Any questions there? I think the next slide is cash flow.
Shondra,
Yes.
can we go back to the P&L?
Yes.
So for cost of goods, when you're shipping something out, is that an expense or is it cost of goods sold?
Yeah, so this is something that is treated differently, essentially. So some people say freight in is cost of goods, meaning like you have to ship it from your manufacturer to your warehouse. That would be cost of goods. And then freight out would be an expense. But I've also seen all freight, both freight in and out in the cost of goods line item. It's really, I wouldn't say it's a personal choice, but it's a choice of how you and your accountant, CPA want to represent the freight costs, but I've seen it both ways.
Okay, that's not that helpful.
Sorry. Is there a reason why you're asking? Let me say that.
Yes, because I've heard it both ways.
Yeah. Yeah, there's no there I haven't nobody has like a set way of doing it. I have two clients right now. One does skincare, one does hair care, and they do it different ways. And it's not a big enough deal for me to say we have to do it one way. And I also don't have like a personal preference. The only thing I'll say is that if you're thinking about your profitability from the standpoint of contribution margin or how much it costs you all in to sell to a customer, it makes sense, in my opinion, to put it in cost of goods. So contribution margin are all the other variable costs of selling a product. And so it's a much deeper way of looking at cost of goods, which gives you a better sense of your gross margin from my perspective, so that you can then really understand your unit costs and get really granular on making your gross margin as efficient as possible.
Okay, thank you.
I'm sorry if that didn't answer your question. Elizabeth, what are your thoughts on using AI tools like Nominal or Flowcast to keep your balance sheet updated? I'm going to be honest, Elizabeth, I've never heard of those tools. I use AI. I don't use AI for my bookkeeping. We are very hands-on with our clients and customers. So we haven't used nominal and flowcast. There are some AI capabilities in QuickBooks, Zero, things like that, but that's typically what we use. When you say update your balance sheet, are you talking specifically about equity cap table management, or are you talking about general assets and liabilities? And while you're typing that out, there are some platforms like Carta that specifically help with updating your cap table, so that equity part of the balance sheet, but it's not necessarily an AI tool. Just bookkeeping and forecasts. Gotcha. Yeah, so for bookkeeping, we are very much hands-on. What was that company called that just Bench? So Bench was a company that they claimed to use AI to like run your bookkeeping for you. And to be honest, and then you had an account manager that you could talk to every month. But to be honest, every client that I had that used Bench, we ended up firing them because it wasn't customized to the business. So it was very much like revenue, cost of goods, expenses, and they were not categorized correctly. And not only were they not categorized correctly, but they also did not include things like inventory. Your balance sheet wasn't updated based on the changes in inventory. And so I'm suspicious of AI tools in that way because I haven't seen one that can be customized and doesn't need a human to help them, right? So like in QuickBooks, like I said, there's some AI tools in there, but there's still some manual work that the humans need to do. Any other questions before we move on? Okay. Oh gosh, sorry guys. I keep thinking that I can go back and forth, but I cannot. Okay, so here is your cash flow statement. Sorry, really quickly, before I get in there, I just thought of something about forecasting. I've used a lot of tools for forecasting, Elizabeth, and none of them have been as nuanced as I needed them to be. And so for forecasting specifically, I personally trust humans because again, they use templates. And even if I use Claude to help me think through some forecasting that I need to do, even now, I can never get it to be as customized and as thorough as I need it to be. So I typically do not use AI tools for forecasting. And we already talked about AI for bookkeeping. Okay, I just wanted to make sure I covered that, Elizabeth. So the cash flow statement, this is very simple, not simple, but very simple. How we see what cash has come into the business, what cash has come out of the business. The reason why I like the cash flow statement, I don't love the statement, but the reason why it is useful is because your balance sheet has all the theoretical movement of cash, right? So let's say you have to pay a vendor. You didn't actually pay the vendor, you just were invoiced for it, but you know that it's due. And so it's a theoretical cost essentially. And so you have to somehow show where that money actually came in, what money actually came out. Or let's say you recognize the revenue on your income or your income statement on your P&L, but that customer, what that really means is that you just invoiced that customer without actually getting the cash. The invoice is sitting in your accounts receivable on your balance sheet, but nowhere has it actually shown what cash has come in, what cash has come out. So this cash flow statement allows those theoretical movements to be rooted in actual fact. So a cash flow statement reports all the cash that flows into and out of your business. This is a report that is over a period of time, not a snapshot like the balance sheet. And the ending cash on this statement is going to tie to the cash and the cash equivalents that you have on the balance sheet. So this is like a true understanding of what cash has actually come in, what cash has actually come out based on some of these theoretical things that have happened on your P&L and your balance sheet. Okay, so we can go into a more detailed example here like we've done for the past two statements. So I'm not going to read, but I'll actually go through this line by line. just so that you have an understanding, because cash flow can get a little bit tricky. So the company, Run KC, they have a beginning cash balance of $57,000. This money would have shown up on the balance sheet in cash equivalents line item. So you're just going to take that, flop it into here, because again, we want to get a very clear understanding of the cash that went in and the cash that went out. So the total cash in includes all the cash that Run KC will receive during the month. So this is actual real cash. This means sales. This means sales on account. This means the money that's actually paid from any invoices that were paid in accounts receivable, any type of equity investment, so money that investors actually put in from equity. This is a very simplified version of this. It's typically shown differently, but for this example, we'll be very, very simple here. And so total cash in for this particular example was $598,000. So we have the total cash available for them to use is $655,000. All of this, so the cash sales, that's going to be on the income statement. So you're going to drop in your net income here for the activity that happened through the month. Your cash sales on account, when a customer finally pays Run KC, all of that is from the balance sheet of what's actually happening on your accounts receivable and your current assets. That's how it ties into your cash flow statement. Your total cash out, all the money that you spent and that was dispersed throughout the month, sorry. So purchasing inventory, if you paying salaries, purchasing of office supplies, any CapEx, paying rent, again, all of that, it's not shown, typically not shown like this, but all of that is going to contribute to your total cash out. And then from there, you're going to take your cash in, very simple, minus your cash out to get your ending cash balance. And again, this ending cash balance should be exactly what's on all of your bank accounts and on your balance sheet. So if I were to go back here, that 47,000 will show up in this line item, the cash and cash equivalents line item. Okay, any questions before I move to the next slide? No? Okay, great. Love that. Okay, so I get excited when I talk about sales projections. I talked a little bit about this at the beginning of the presentation, but this is really how you understand how much cash you'll need for your company and also how you set goals, revenue goals, sales goals, margin goals. And we're going to talk about some ways that you can think about projecting. Do you guys do projections for your company already? Is that something that you guys do?
I have one person saying no.
Oh, no. Okay. Well, we're going to teach you a little bit. So before I move on then, how do you guys plan for the next month, quarter, year of growth for your company?
We don't. Well, I don't.
I think someone said something. I didn't hear you though.
Yeah, he said he doesn't, not yet
not
anyways.
Oh, okay. Gotcha.
So
Okay.
people here are very new to their business. We have one person who has been in business for a while, but I think most people here are either at the beginning or still in kind of ideation.
Okay.
So you won't have a lot of people generating a lot of revenue except for one person in this room who.
Okay, that's very good information. I love that. So let me take a step back then. Before we even go into this, I want to talk about the reasoning for doing sales projections. I've worked with a lot of founders that do sales projections at this stage, right? At the ideation stage, because they need to think about, or they want to think about talking to investors and telling them how big the company could be, which is a great exercise. But I think that the purpose or the best reason for doing projections, and it doesn't even have to be incredibly formal and detailed, but the reason why you want to at least sit down and start to think through this is because it allows you to know what levers to pull as you're growing your business. So when I say levers, let's say something happens in the market and you're producing, I don't know, body butters, and something happens in the market where the cost of one of your ingredients goes up. If you've done some of this work, you'll know what other levers you can pull to maintain that same margin profile. So maybe you know that if you reduce the size or the cost of packaging, you can continue to maintain the same margins. Or maybe you know that you're putting in a certain type of ingredient, but you can actually, because of this fragrance, I'm just coming up with examples, but you can use another ingredient, changes the fragrance slightly, is cheaper for you, and allows you to maintain the same margin profile. Or if you've done some of this research, you know that selling bundles would, even though the cost of the ingredient goes up, but selling bundles is something that your customers love. And so you'd be able to get more revenue by now selling bundles. So there's just things that you've already thought through that allow you to really understand the cost levers and the sales levers for your business so that you can hit some of those goals. The goals that you could be considering are revenue goals, like I said, margin goals. So making sure you're keeping as much money after selling and producing the product as possible. And then there are some like operating goals, net income goals, or net margin goals, things like that. So I'll say that there is definitely a benefit to doing this in this stage because you've done some of that exercise or some of the work and the exercise to really get to know your business from a quantitative perspective. So your sales projections, basically, you want to understand well, I'll follow this and then I'll give my thoughts after that. So you're looking at your sales minus your cost to produce the product or the cost to produce the service. That's going to give you your gross profit. Again, we're basically walking through the P&L. Your gross profit subtracting by what it costs for you to operate the business is going to give you your net income. If you have an idea of, and again, remember, we kicked off this conversation talking about predicting, measuring, analyzing, and then predicting again. So if you're starting out and you don't know some of these numbers, if you understand the industry, you're going to be making some predictions, and over time, you'll actually be measuring those. So then you'll be able to get some really good data and insight on how to project into the future. These things can get really complicated, but there's 3 ways that you can do this. You can compare it to other companies in your industry, which I talked about a little bit at the beginning. You can do some measuring over time. So what are my sales over the past 3 months, 6 months to a year? What are my costs past 3 months, 6 months to a year, to get an understanding of what the average growth rate would be, or the average sales rate, or the average number of customers, and you can use that to project over time. Or you could also do a bottom-up approach where you're really looking at your cost of sales and trying to understand what back into your profit, saying I want 60% profit margin, which means I need to sell it at this amount, which means I need to make this amount of money and I need to have this many customers. So there's multiple ways that you can do your projections. If you're just starting out, I'm thinking through this while I'm saying this live. If you're just starting out, depending on the type of business that you have, it's easiest to do a couple of ways. It's easiest to do a bottoms-up approach, right? That means you're looking at all the costs that it takes for you to produce the product and then backing into the revenue number and or the price of the item. And then you can multiply that by the number of customers you think you can get. Or you can look at the size of industry. Investors don't like this, but this is a way that you can get some sense of what your revenue could be. You look at the size of industry. So let's say, and it's going to take some Googling to get this number, but let's say there are, I don't know, 100 accountants in your town, and Google says that the average accounting firm makes $200,000 a a year, right? So if you multiply your 200,000 by your 100,000, I think that's 2 million or 20 million, I don't know. And you say, all right, I want to capture 1% of the market. Then you're able to do the math and get a revenue projection that way. So those are two ways that if you're just starting out. But if there is more detail that you want to do, I'm happy to work with you on that. I can do that for you, where we're looking at costs, COGS on a line by line basis, and we can get a much better view on what your sales projections could be. But we'll go over how, all of those ways to do sales projections in this presentation. Okay, so before I move on, questions. All right, so the comparative sales approach. So this is, I mentioned this earlier, when you research your competitors and your industry. If you're in an industry that has companies that are public, so they've IPO'd, they're selling on the stock market, those companies have to produce annual reports, they have to produce quarterly reports, and there's so much information in there. And so I would read some of those S1s, 8Ks, 10Ks to get information. Otherwise, you can do research in your local community. You can reach out to people on LinkedIn. You can do some Googling. You can talk to the SBA in your region or in your town. But you're basically looking at what your industry mates are doing and seeing what you think you could do based on that comparative or that knowledge that you've received. Some people say this is an accurate way to do it. It depends on, it's as accurate as the information that you can get, but this is going to take a lot of work on your part to get accurate information. Okay, so an average sales approach, this is when you've been in business for a bit of time. So you can either look at, some people look at weekly sales, some people look at monthly sales. You can look at the average sales rate. You can look at the growth month over month or year over year. You can also look at, what was I about to say? I just lost it. I'll come back to that. And I'll use the example here. So this restaurant owner figured that the average price of each meal sold, he looked at the average price of each meal sold, and then he looked at what he thought the annual or the number of customers he would get every day. So 60 customers every day, $15 on average price of a meal, times to $365, 365 days would get him what he could expect to make in a year, which is $328,000. So that's another easy way that you can do it, but that would take you to be in business and to have some historical data so that you can base your assumptions on actual fact, essentially. Here is the bottoms up sales approach. So again, this is depending on how you do, this could be very easy where you're just looking at cost of sales and then adding in your profit margin that you want to make. And then from there, grossing it up to get your projected annual sales. But essentially, you're looking at, let's say, for example, let me see if there's an example here. There's not. Oopsies. Sorry, guys. So let's say it costs you $20 to make an item and I am going to mess up the math here. And you want I'm going to mess up the math, but if it costs you $20 to make something, right? And you want your 20% profit. So you basically multiply the $20 times 1.2 to get the cost of the item. And then from there, you'd say, and I want to sell it to 100 customers. So you'd multiply that price by the number of customers to get what your projected annual sales would be. Before we go into examples, any questions?
No question.
Okay. So here's some questions to ask yourself as you are thinking through projecting out your costs. So I have a sheet where we go through literally every single thing that most startups would spend money on in the first 18 to 24 months. And I call that a use of funds. And that's how we decide how much money they need to go out and raise, or how much money they can expect to spend to operate their company in that time frame. So what are the different types of startup costs, and can you measure them, right? So that could be design work, that could be, if it's a CPG company, packaging, that could be a PR firm. I do not suggest getting a PR firm, but it could be a cost. That could be contractors. I'm trying to go through this line item. That could be, if it's a tech company, development costs, server costs. It could be costs to sell your product on Shopify, Stripe fees, things like that, where you're literally, what I like to say is, you are following two things. You're following the customer from the time that they first get introduced to you to the time that they buy, and checking all the points in which you may need to spend money. So if you are selling something at a farmer's market, right? The customer is going to find you at the farmer's market, but you had to drive to the farmer's market. So how much gas did you spend? How much time did it take you to set up? What's your hourly rate? How much would you pay yourself? Or let's say you have an employee. How much did you pay your employee at the farmer's market? The packaging that the item is in, the bags that you sent home with the customer, like every single, if you're following the customer and you're following the product, you will figure out all the costs needed for you to run your company. But that's just a mental exercise that you'll have to do. The second question, how do cost of goods sold and operating expenses relate to profitability? We have been talking about that ad nauseum today, but making sure that you understand the cost that it takes you to produce the product and the cost that it takes you to operate the business. And again, understanding the levers that you can pull so that your customer is always insanely happy and you're making them happy at the cheapest rate possible. Why does the way inventory is managed have an impact on profits? This could be a completely separate presentation, but for a lot of you, if you're just starting out, inventory management isn't something that you'll have to think about. But for those that are working with a 3PL, logistics, making sure freight costs, all of that is super, super important and contributes heavily to your gross margin. What are the three functional areas of operating expenses? So really looking at what I would say are your fixed costs separate from salary. So what does it cost to keep the lights on, like literal lights, internet, overhead, things like that? And then your people costs. So how much does it cost you to pay the people to help you run your business, including yourself? Pay yourself, please. And the third functional area that I would say is the marketing piece. If you are a consumer company, or a company that is but basically a company that is marketing directly to consumers, so not businesses, your marketing costs is a very large part of your P&L. And the key is to be able to acquire customers the cheapest way possible. And right now it's a bloodbath out there with consumer brands. So really understanding your marketing costs is super, super important as you're doing your cost projections. And again, if you're doing that exercise of following the customer as soon as they find you, as soon as they find you, and then following the product, I keep raising my hand, you will get a better sense of your marketing costs, or at least where you need to spend.
You have a question online from Elizabeth?
Oh, Elizabeth. Okay. So for a nonprofit projection, it would look different, right? Yes. It would track donations and contributions, individual giving, planned giving, program service revenue, special events and fundraisers. Yes, 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 and yes. And so for a comparative sales approach for nonprofits, would you compare fundraising and revenue channels? Yes. Donations, grants? Yes. The answer is yes. That's exactly what I would do. I would also look at nonprofits in your industry, maybe not even in your city or your locality. I would look at companies that are serving or nonprofits that are serving your customer base to see how they are set up, where they're fundraising, who is backing them, and then the programs that they have. I have a friend who runs a nonprofit, and we talk all the time about how it is a balance between the revenue that he's generating through his programs, but then also the funding that he's getting from the backers. And so if there was another, and he also tells me a lot about the different nonprofits that are doing the same work, but are in different locations, and how he typically talks to them to help him think through strategy for the coming years. So you answered your own question. Great job, Elizabeth. Everything you said is correct. Any other questions before I move on?
No.
Okay, here's an example. This is Etsy Emmy. She does bangles. Okay, so you're welcome. So here are some of the startup costs. Capital expenditures. For most of you, you won't have to worry about that, but that could be a machine. It could be somewhere where you're manufacturing bangles or body butters or whatever it is. Security deposits. So let's say you're purchasing something and you need to put a deposit down for the item, equipment, rent deposits, furniture, again, phone, lease agreements, or sorry, leasing improvements. All of these things are things you will know if you do the practice of following your customer and following the product. Because as you're thinking about whose hands touch what part of my business touches this, how do I get it from point A to point B? If you do that math, that exercise, you will figure out what all of those startup costs are. Because you're going to say, oh my gosh, I need to put my product in a box. I don't know how to make boxes. I also don't know how to design boxes. Those are costs that you're going to have to incur in order for you to get your product in the hands of your customer and for your customer to be incredibly delighted. So I would do that exercise, and that will cover a lot of these things. If I could pull it up quickly, and I may be able to, actually, I'm going to go off script really quickly so that you guys can see if I can pull this up really quickly. 1 second, because I know I have it. Oh, man. Okay, I'm going to try and pull it up in a bit, but it's saying that I have to log in, and that's annoying. Actually, I think I can do it, guys. I want you guys to see this use of funds because it's super... Okay, here it is. Okay. Let me see if I can share my screen. Share. Application windows. Here it is. Okay. Okay, so can you guys see that? No. Is it still on startup costs?
Yeah.
Yeah.
Oh, I'm sorry. I didn't press the share button. Okay. Come on.
We see it. I think we see it. Is it a spreadsheet?
Yes. Okay, cool. So this is a 2-year use of funds. The first section I have here is payroll. I also include taxes and benefits, so we get a total salary number. But here are some of the things that I say that you'll need to think about when you're thinking about costs. Cloud hosting, maybe you have an international designer or UX designer, an international engineer, software, additional custom web development, Shopify web hosting, email marketing, equipment. So it gets really detailed, right? If you have an inventory, product development, sourcing, the actual inventory, packaging, additional packaging, sometimes there's primary packaging and some secondary packaging, freight costs, shipping, returns, getting into marketing. Again, I said that this is a really big functional area. If let's say you have SEO that you need to pay for, digital displays, any retargeting that you want to do, influencer costs, if you need a copywriter, these are all the things that I have seen startups pay for. I do not agree with all of these things. However, These are things that you could potentially pay as you are getting your company up and running. Here's some other G&A. I'm sure there's more here, but accounting and bookkeeping, legal, insurance, travel. Some people have founder coaches, support, recruiting. So this is as detailed, and I would say probably even more detailed. I pulled back here because I wanted this to be applicable to a number of industries, but this is the type of detail that you want to do when you're doing your use of funds or your cost projections. Does that make sense?
Yes.
You have a question in class?
Hello.
Hi.
I was just wondering, is it possible to get a copy of that file, or can we find that somewhere with that,
Yes.
all the details of
Yeah, I
really
will
good,
send it over.
really
I'll
good
send it
file?
over to Maggie, and Maggie can disperse it.
Okay. And I actually have another question. It's about you said you were against PR firms. Is PR the same as trying to make a product, example of the product, whether it's VR, I mean, not VR, but a computer model or a physical example of something to show a potential client?
No,
It's
no.
not
So
the same thing. Okay.
yeah, PR in this case, or in the case that I'm talking about, is public relations. So this is you paying a firm, and they're very expensive, $10,000 a month, $5,000 a month on retainer to put your name into a magazine to get you earned media. And at the beginning of building a business, I'm always like, just create the product. Let the product be great. Spend all your money on the product and then use the guerrilla marketing tactics that you can to get it into the right hands. But whatever you're selling needs to be so good that the moment that a customer touches it, they want to tell somebody else.
Okay.
And
Yes, thank you.
You don't need to pay $10,000 a month for that to happen. Go ahead.
I agree. Oh, no, I just said thank you. And then
Oh,
I agree.
yeah, yeah. Okay, so am I over? I don't know what time I'm supposed to end, Maggie.
It's supposed to be about over now, but can you finish the accounting part of it and we won't worry about the sales part?
Yes. So let me go back to this part. This one. Okay, so this was an example for the startup costs, and I wanted to just show you what some of the things that you should be thinking about. Okay, it's not letting me. All right, and here is how do you find and estimate your startup costs. So these are some of the questions that you have to think about. Where's your business located? What size will it be? Again, doing that exercise of following the customer, following the product will again help you get all of these costs and estimate them. So here are some of the things that you can think about as far as cost of goods. So it's labor, cost of materials, and the materials and the parts that's necessary. Those are your cost of goods. Cost of sales are usually just your labor and the cost of your direct supplies. And again, really understanding your cost of, here it's mentioning raw materials, is super important because from like line item to line item, because it allows you to again use your levers to adjust for better margins. Your operating expenses, so this is R&D. Some of you are probably doing R&D right now, sales and marketing, and then your general and administrative. I always like to say, for me personally, I like to think through the people costs as operating expenses as well. These are people that are operating the business, not necessarily producing the product. And so general administrative are those things like your rent, insurance, cleaners, like the general things that it takes you to operate the business. Obviously, R&D is the research for your product, and then sales and marketing is the marketing costs and the cost of a sales team if you have one. These are some funding options for new business owners. We talked a little bit about this. SBA loans, they take a long time and they require a lot of information, and they're usually personally guaranteed. So you need to have good personal credit. Your financial records need to be organized. They need to be easy to pull. And I talked about this earlier as well. You can get lines of credit. It's going to be hard to get lines of credit from at the beginning, but they are something that help a lot of founders scale. Typically what I've seen for lines of credit are typically the business has to be already operating, already generating revenue, because they are, one, looking at your assets, your receivables, and your sales to understand the size of the line. Grant programs are really good. I know that right now it's a little dicey with getting grants, but there are still private organizations that are providing grants. The process can be also long. There are some people that specialize in grant writing, so that may be something that for you, particularly depending on the industry that your business is in, it may make sense for you to look at grants. The other non-dilutive funding options are pitch competitions. A lot of people fund their business at the early stages with pitch competitions where the prizes are non-dilutive funding. Accelerator programs, some of them offer non-dilutive funding as well. Microloans here, crowdfunding. Crowdfunding has fallen out of favor, but it is a way that I've seen some businesses continue to thrive in challenging markets. Okay, so here are some of the things that you will need as you prepare. We talked a little bit about this earlier, but you want to make sure that you are, especially starting out, because I see this all the time, you want to make sure that your bank accounts are separate, personal and business. If you have somebody doing your accounting, it is very tedious and tiresome to separate the business and the personal transactions. So please separate those accounts. You also want to have a professional bookkeeping system, QuickBooks Zero. There's a couple of others out there. And if you're just starting out, you can pretty much do it yourself, honestly. But as your business gets more complex, you have more transactions, it's easier to have somebody else do it. Also, you want to make sure that you are following tax compliance and have all of your documentation and your registration up to date. You really can't do a lot like open a business account, a checking account, any of that without being a registered business entity. So that should be one of the first things that you do. Some of the documentation to maintain here, your monthly financial statements, projections, which we talked about, business plan, nah. I would more so really have a deck that you can send to potential investors or lenders so that they get an overview of your business. And then once you meet with them in person, you provide the talk track. A lot of that information that would be in your business plan, you're able to talk over that and voice over it. Obviously, you want to have all your business licenses and registrations. Here are some readiness assessments to look through. I think Maggie, you'll send this out to them as well. This is your preparation timeline for funding. It's taking a lot longer nowadays than it was even 6 months ago, a month ago, or a year ago. So you want to make sure that all the things that we talked about, that you are maintaining those so that going through this process of preparation is much smoother. Okay, and oh, this is not me. All right, I think that's it.
Okay, questions?
Nothing online and nothing in the room.
Okay, way to bring it home.
I know, 10 minutes over. I'm sorry, guys.
You did a great job.
Thank you.
Of course. I hope you guys have a great evening. And again, my email is here. If you have any questions, please feel free to reach out. And I know it was a lot of information, so sorry if I was going too fast, but again, I'm happy to help. So any question that you have, shoot me an email and I'm happy to walk through some of these things or help you think through it.
Where's your email?
I will make sure that your email is pinned with this deck. In this.
Yeah, yes. So we'll send that to you. I'll have Tina send that to you tomorrow, Maggie, so you can send it out.
Wonderful.
Thank you guys. Talk soon.
Thank you. Thanks, everyone.
Bye-bye.